Welcome to session 13, Mergers, Acquisitions and Restructuring. Mergers, acquisition and restructuring have become commonplace. We hear about these transactions all the time. Almost every day we hear of one or more transactions in India or abroad. These transactions are redefining corporate landscape. They have a tremendous impact on value creation as well as value destruction. The outline of the session is given here: importance of corporate restructuring, types of transactions, plausible and dubious reasons for mergers, mechanics of amalgamations, financial aspects, takeovers, track record of acquisitions, managing an acquisition, business alliances, divestitures, holding company, and privatization. For many companies, mergers, acquisitions, and restructuring are number one business priority. These transactions have become dominant global business theme. They have a huge impact on value creation and value destruction. They have a great influence over resource allocation in the economy. Here are some prominent deals: a $100 billion merger between DuPont and Dow Chemicals, a $160 billion merger between Pfizer and Allergan, a $100 billion merger between Ab InBev and SAP Miller, Sun Pharma's acquisition of Ranbaxy from Daiichi Sankyo, Tata Steel's acquisition of Chorus worth $13 billion, Hindalco's acquisition of Novelis for $6.7 billion, Bharti's acquisition of Zen, Abbott Laboratories acquisition of the healthcare division of Piramel, so on and so forth. There is a compelling macroeconomic logic for mergers, acquisitions, and restructuring. Many believe that an active market for corporate control improves allocation of resources in the economy. The US is a prime example of this phenomenon. A vibrant market for corporate control in the US has facilitated a better allocation of resources in the economy. There is a powerful business imperative for mergers, acquisitions, and restructuring. We have learned that organizations can make organic investments as well as inorganic investments. Inorganic investments often cost less, have lesser risk, and involve lesser time. So there is a powerful business imperative for inorganic investments. Despite a compelling macroeconomic logic and a powerful business imperative, the track record of acquisitions is somewhat dismal. In this session, we'll examine why firms have erred in their decision making, why firms have destroyed, and what can possibly be done to improve the probability of success for these transactions. The forces that are catalyzing mergers and acquisitions are technological changes, globalization, deregulation, overcapacity, race to become bigger. Acquisitions seem to offer certain advantages over internal growth. The time required for an acquisition may be less than the time required to set up a greenfield project. The difficulty involved in a greenfield project may be more than the difficulty involved in an acquisition. The cost of an acquisition may be lower than the cost of a greenfield project. The risk associated with an acquisition may be lower than the risk associated with a greenfield project. M&A trends in India. From early 1990s, M&A have been an enduring feature of the Indian corporate landscape. A significant share of M&A is M&A between affiliate concerns. Hostile takeovers are rare in the Indian context. Indian legal and regulatory environment favors overseas acquisitions compared to domestic acquisitions. No wonder Indian companies have shown great appetite for overseas acquisitions. Very broadly, corporate restructuring transactions can be divided to two categories: acquisitions and divestitures. Acquisitions occur in three ways: mergers, purchase of a business unit, takeover. In a merger, two or more companies combine together to form a single company. In a purchase of a unit, one company acquires a business unit or business division of another company. The two companies retain their separate corporate identities. In a takeover, one investor acquires controlling equity stock in a company from another investor. When these transactions are facilitated with the help of high financial leverage, they are called as leveraged buyout transactions. Divestitures occur in three ways: demerger, slump sale, sellout. A demerger is a mirror image of a merger. In a demerger, one company is split into two or more companies. A slump sale is a mirror image of purchase of a unit. In a slump sale, one company sells a division or unit to another company. Sellout is the mirror image of a takeover. In a sellout, one investor sells out controlling equity interest in a company to another investor.
In the market for corporate control, fusion in the form of mergers, takeovers, asset purchases attracts a great deal of attention and publicity, but fission in the form of demergers, sale of equity stake and asset sales can be just as important. Fusion is motivated by synergy, which says 2 plus 2 is equal to 5. Fission is motivated by energy, which says 4 minus 3 is equal to 2. There are two forms of merger: absorption and consolidation. In an absorption, one company takes over the assets and liabilities of another company and emerges as a larger company. For example, company A takes over the assets and liabilities of company B and emerges as a larger company. Shareholders of company B are paid shares of company A in lieu of their shareholding in company B. In a consolidation, two or more companies fuse together to form a new corporate entity which takes over the assets and liabilities of the merging companies. The shareholders of the merging companies are given shares of the newly formed entity. There are three types of merger: horizontal, vertical and conglomerate. In a horizontal merger, two or more companies engaged in the same line of business merged. In a vertical merger, two or more companies engaged at different stages in an industry merge. In a conglomerate merger, two or more companies belonging to different industries merge.
Here is an example of a merger. Tomco was merged into Hindustan Lever Limited. Tomco was a smaller entity. Hindustan Lever was a larger entity. The assets and liabilities of Tomco were taken over by Hindustan Lever. The shareholders of Tomco were given shares of Hindustan Lever in lieu of their shareholdings in Tomco. After the transaction, Tomco was dissolved. In 2016, Cairn India Limited merged with the metals and mining giant Vedanta Limited in an all-share deal amounting to 2.5 billion USD, whereby the public shareholders of Cairn were allotted equity and preference shares of Vedanta.
Here is an example of purchase of a business unit. Coromandel Fertilizers had two business units, fertilizer unit and cement unit. Rasi Cement, a cement player, wanted to acquire the cement unit of Coromandel Fertilizers, so it acquired all the assets of the cement unit along with liabilities which were specific to the cement unit. In turn, it paid compensation to Coromandel Fertilizers. After the transaction, Coromandel Fertilizers became a pure fertilizer company and Rasi Cement expanded its cement capacity.
In a takeover transaction, one company acquires controlling equity stake in another company. Here is an example. Hindalco was controlled by Alcan, a Canadian company which had a 54% equity stake in Hindalco. Hindalco was interested in acquiring the equity stake that Alcan held in Hindalco. Hindalco paid cash compensation to Alcan to acquire 54% equity stake that Alcan had in Hindalco. As a result, the controlling interest was shifted from Alcan to Hindalco. The two companies remained as separate entities for a while. Subsequently, Hindalco was merged with Hindalco. This seems to be the typical pattern. Initially, a takeover takes place. After some time, the company which is taken over may be merged with the company which has taken over the company. A leverage buyout involves acquisition of another company with substantial financial leverage. Here is an example. In March 2000, Tata Tea acquired Tetley of UK for a compensation of £271 million. Tata Tea set up a special purpose vehicle to effect this acquisition. This SPV was called Tata Tea Great Britain. Tata Tea Great Britain raised £70 million of equity from Tata Tea and Tata Tea Incorporated and £235 million of debt. It issued 4 tranches of debt A, B, C, D, having maturities varying from 7 to 9.5 years and carrying a coupon of around 11%, which was 424 basis points over LIBOR. Since the debt was considered to be low-grade debt or junk debt, it carried a high rate of interest. Typically, low-grade bonds carry an interest rate which is 3, 4, 5% higher than the interest applicable to investment-grade bonds. After the transaction, the balance sheet of the special purpose vehicle looked like this. The principal asset was the Tetley brand, which was valued at £271 million. Expenses were recorded on the balance sheet. These are deferred revenue expenditures. Working capital of £25 million was there. The total was £305 million. This was supported by £70 million of equity and £235 million of debt. Mergers are driven by some plausible reasons and some dubious reasons. The plausible reasons are strategic benefit, economies of scale, economies of scope, economies of vertical integration, complementary resources, tax shields, utilization of surplus funds, and managerial effectiveness. The dubious reasons are diversification and earnings growth. The merger of Reliance Petroleum Limited with Reliance Industries Limited in 2002 represented the largest ever merger in India till then, creating the largest private sector company in all financial parameters, including sales, assets, net worth, cash profit, and net profits. Defending the merger, the management claimed that the merger will contribute to the following benefits for RIL, thereby enhancing shareholder value: scale, integration, global competitiveness, operational synergies, logistics advantages, cost efficiencies, productivity gains, rationalization of business processes, optimization of fiscal incentives. I mentioned earlier that two dubious reasons are diversification and earnings growth. While diversification often a dubious reason, let us look at the rationale proffered by managements when they are engaged in a merger. They say that the merger will create an entity which is more diversified, so shareholders are likely to benefit. If you look at it carefully, shareholders need not benefit from corporate diversification because they can create a diversified portfolio on their own. I need not depend on two companies A and B to merge to get the benefits of diversification. I can buy shares of A and B separately in the marketplace to create a portfolio which is diversified. I can choose the proportions in which I invest in A and B which suits my purpose. So corporate diversification does not necessarily enhance shareholder value because shareholders can on their own do that diversification perhaps more efficiently. We'll examine earnings growth next. If a high PE company acquires a low PE company and the compensation is paid in stock and the exchange ratio is based on the prevailing market price, such an acquisition leads to an increase in EPS. A numerical example will illustrate this phenomenon. These are the financials of two companies, Ram and Shyam. Ram currently has an EPS of rupees 2. It commands a price earnings multiple of 20. Its market price per share is rupees 40. Shyam has an EPS of rupees 2. It commands a price earnings multiple of 10 and a market price of rupees 20. The market assigns a higher multiple to RAM because it believes that RAM has superior growth prospects compared to Sham. The number of outstanding shares of RAM and Sham is 10 million each. Total earnings of RAM and Sham are rupees 20 million. The market value of RAM is rupees 400 million. Total earnings of rupees 20 million multiplied by the price earnings multiple of 20. The market value of Sham, however, is only rupees 200 million. Total earnings of rupees 20 million multiplied by a P multiple of 10. Now Ram acquires Sham and shareholders of Sham receive shares of Ram. Since the exchange ratio is based on the prevailing market price, one share of Ram will be given in lieu of two shares of Sham. So for 10 million shares of Sham, 5 million shares of Ram will be issued. As a result, the combined entity will have 15 million shares. The total earnings of the combined entity will be rupees 40 million because no synergistic benefit is expected. The EPS of the combined entity goes up to rupees 2.67 because total earnings of 40 million are divided by 15 million. So EPS becomes rupees 2.67. If the market is foolish, it continues to assign a higher multiple of 20 to the EPS of the combined entity and market price per share becomes 53.4 and the company enjoys a P multiple of 20. Since the total earnings are rupees 40 million, the market value becomes rupees 800 million. If the market is smart, it will reason as follows. It will say, we assigned a higher multiple to RAM because of its superior growth prospect and a lower multiple to Sham because of its inferior growth prospect. The combined entity would have middling growth prospect, so we'll assign a multiple of 15 to the combined entity. If the market assigns a P of 15 to the combined entity, the market value of the combined entity would be 15 multiplied by rupees 40 million, which is rupees 600 million. So there is no change whatsoever as far as market capitalization is concerned. The market capitalization of the combined entity is the sum of the market capitalization of the independent entity. We often think market is foolish, but market is generally smart. Market sees through this game, and the illusion of higher EPS need not necessarily result in higher market capitalization. Mergers, acquisitions, and restructuring are very complex transactions involving legal, tax, accounting, and regulatory aspects. The merchant banker who consummates this transaction puts together a team of experts drawn from various areas. We'll briefly note what is involved without getting into technicalities or details. Mergers are referred to as amalgamations in the legal parlance. The legal procedure for an amalgamation is shown here. The transaction has to be approved by the boards of the respective companies. After the boards approve the transaction has to be approved by shareholders and creditors by passing a special resolution which requires 75% of the voting rights. After shareholders and creditors approve the transaction, it is filed with National Company Law Tribunal. NCLT examines the transactions, hears various parties, and finally passes an order. After the NCLT order is passed, transfer of assets and liabilities takes place along with issuance of shares and debentures.
Tax aspects of amalgamations. The merging companies are called amalgamating companies and the merged company is called amalgamated company. The amalgamated company is entitled to various tax benefits if A. All the properties and liabilities of the amalgamating company become the properties and liabilities of the amalgamated company
and B. Shareholders holding not less than 90% in value of the shares in the amalgamating company become shareholders of the amalgamated company by the virtue of amalgamation. From an accounting point of view, these transactions are referred to as business combinations. It is interesting that they are referred to as amalgamations in the tax and legal parlance, but they are called business combinations in accounting. There are two kinds of business combinations: common control business transactions and other than common control business transactions. Common control business transactions are transactions that take place between firms in the same group. For example, if there is a merger of one Tata company with another Tata company, it will be referred to as a common control business transaction. Such transactions are treated using the pooling of interest method. Other than common control business transactions are transactions between firms which belong to different groups. Such transactions are treated in accounting as per the acquisition method. Competition Commission of India is a regulatory body. An acquisition requires approval of the Competition Commission of India if such an acquisition exceeds certain financial thresholds and is not within a common group. To understand the financial aspects of acquisitions, we need familiarity with some concepts. Market value. This is the existing market value of a target company. Intrinsic value. This is the intrinsic value of the target company. Apparently, the target company is undervalued, so it is an attractive acquisition candidate for a potential acquirer. A potential acquirer can derive certain synergistic benefits by acquiring the target company. The value of synergistic benefits may be 200. The acquirer is required to, in most cases, pay a premium over the current market value. The premium may be 20, 30, 40% over the current market value. If the premium paid is 30%, then acquisition premium would be 240. Based on the numbers just mentioned, a table like this can be prepared. On the right hand side is the market value of target 800, premium to be paid 240, so total price to be paid is 1040. On the left hand side is intrinsic value 900, NPV of synergies to be derived by the acquirer 200, so gross value of acquired assets 1100. The value of the acquisition to the shareholders of the acquirer is 60 because the gross value of acquired assets is 1100 and total price paid is 1040. The benefit to the shareholders of the target company is 240. From this example, we find that the primary beneficiaries are the shareholders of the target company and the secondary beneficiaries are the shareholders of the acquiring company, and this happens to be the empirical reality in most of the acquisitions. We can do a more formal analysis of the previous illustration. Let us assume that acquirer is A, target company is B, present value of the acquirer before the acquisition is 2000. The benefit that is derived from the merger to shareholders of A and B put together is present value of AB. This is the present value of the combined entity minus the sum of the independent values of A and B. We learned that the gross value of the acquisition would be 1100. So present value of AB would be 2000 plus 1100, which is 3100. Present value of A is 2000. We learned that present value of B is 800. So the total benefit derived is 300. This would be shared between shareholders of firm A and shareholders of firm B. What is the cost to shareholders of firm A? Cost to shareholders of firm A is equal to cash compensation paid to shareholders of B minus present value of B. If the cash compensation is 1040 as we assumed in the example and present value of B is 800, the cost is 240. The total benefit is 300, which means the benefit to shareholders of firm A would be 60. Total benefit is 300, cost is 240, benefit to shareholders of firm A is 60. It can also be expressed in this manner. This is the expression for benefit and this is the expression for cost. So it can be put as PVAB minus PVA minus cash, which is 3100 minus 2000 minus 1040. This is equal to 60. This is the net benefit to shareholders of firm A. Net benefits to shareholders of firm B is 240. The total benefit is 300. Here is another illustration. Firm A has a value of rupees 20 billion and firm B has a value of rupees 5 billion. If the two firms merge, cost savings with the present value of rupees 5 billion would occur. Firm A proposes to offer rupees 6 billion cash compensation to acquire firm B. Calculate the NPV of the merger to the two firms. In this example, present value of A is rupees 20 billion, present value of B is rupees 5 billion. Present value of AB would be rupees 30 billion, 20 plus 5 plus cost savings of 5. Cash compensation is rupees 6 billion. Therefore, benefit to shareholders of A and B put together is present value of AB, which is rupees 30 billion, plus PVA plus PVB, which is 25 billion. So total benefit to shareholders of A and B put together is rupees 5 billion. Cost is cash compensation minus present value of B, 6 billion minus 5 billion, rupees 1 billion. NPV to A is benefit minus cost. Benefit is rupees 5 billion, cost is 1 billion. So NPV to A is rupees 4 billion. NPV to B is cash minus PVB, which is rupees 1 billion. In this case, the bulk of the gains are appropriated by the shareholders of firm A, which is not normally the case. What happens when compensation is paid in stock, not cash? In this case, costs and benefits are defined somewhat differently. The overall benefit, of course, is present value of AB, the combined entity, minus the sum of the independent values of A and B. As far as the cost of the merger is concerned, it is defined as alpha PVAB minus PVB. Since shareholders of firm B are paid stock compensation, they acquire a certain stake in the equity of the combined entity PVAB. Let us assume that the stake that they acquire is alpha percentage. So the cost of the transaction would be alpha PVAB because this represents the value of compensation paid to shareholders of firm B minus the independent value of B. NPV to A would be overall benefit minus cost defined in this manner. NPV to B is cost to A. The formula can be illustrated with an example. Firm A plans to acquire firm B. The relevant financial details of the two firms prior to the merger announcement are firm A market price per share rupees 50, number of outstanding shares 1 million, market value of the firm rupees 50 million. Firm B market price per share rupees 20, number of outstanding shares 500,000, market value of the firm rupees 10 million. The merger is expected to bring gains which have a present value of rupees 10 million, which means after the merger, the value of the combined entity would be 50 plus 10 plus 10, that is rupees 70 million. Firm A offers 250,000 shares in exchange for 500,000 shares to the shareholders of firm B, which means the exchange ratio is 1 to 2. What does it mean? It means that shareholders of firm B will have 250,000 shares of the combined entity, which will have total outstanding shares of 1 million plus 250,000, that is 1.25 million. So shareholders of firm B will have an equity stake of 250,000 divided by 1.25 million, which works out to 20%. The apparent cost of acquiring firm B is 250,000, the number of shares given to shareholders of firm B, multiplied by rupees 50, which is the current market price of the shares of firm A, minus rupees 10 million, the present value of firm B. This works out to 2,500,000. The true cost, however, is greater than rupees 2,500,000. The true cost when shareholders of firm B get a fraction alpha of the share capital of the combined firm is equal to alpha times PVAB minus PVB. In this case, remember PVAB would be 70 million, PVA plus PVB plus synergistic gains. So cost would be alpha times PVAB minus PVB. In our example, the share of B in the combined entity will be alpha is equal to 250,000 divided by 1 million plus 250,000, which is 0.2. So the cost is 0.2 times PVAB, which is 70 million, minus PVB, which is 10 million. It works out to 4 million. The true cost is rupees 4 million and not rupees 2,500,000. Here is another illustration. Black & Company plans to acquire White & Company. The relevant financial details of the two firms prior to the merger announcement are given here. Black & Company market price per share rupees 70, number of outstanding shares 20 million. White & Company market price per share rupees 32, number of outstanding shares 15 million. The merger is expected to generate gains which have a present value of rupees 200 million. The exchange ratio agreed is 0.5, which means one share of Black & Company will be given in lieu of 2 shares of White & Company. What is the true cost of the merger from the point of view of Black & Company? Shareholders of White & Company will get 7.5 million shares of Black & Company. The number of outstanding shares of White & Company currently is 15 million. The exchange ratio is 1 to 2. So shareholders of White & Company will get 7.5 million shares of Black & Company. So they will get a stake which is equal to 7.5 million divided by 20 million plus 7.5 million. 20 million is the existing number of outstanding shares of Black & Company. When Black & Company issues 7.5 million shares to shareholders of White & Company, the total number of outstanding shares of Black & Company would be 27.5 million. White & Company shareholders would get 7.5 million. So they will acquire a stake which is 3 by 11 of Black & Company. The present value of Black & Company after the merger will be rupees 70 multiplied by 20 million plus rupees 32 multiplied by 15 million. This is the present value of Black & Company as it is. This is the present value of White & Company as it is. This is the gain from merger. So if we add all of these numbers, we get a present value of Black & Company after the merger to be rupees 2080 million. The true cost of the merger will be 3 by 11, the share acquired by shareholders of White & Company multiplied by rupees 2080 million minus rupees 480 million, the current value of White & Company. This works out to rupees 87.27 million. From the previous discussion, it is obvious that the value creation as a percentage of deal for the acquirer depends on the premium paid and performance improvement or synergistic benefits realized. The premium paid usually is between 10% and 40%, and the value of performance improvement is also usually between 10% and 40%. If the premium paid is 40% and the value of performance improvement is just 10%, the acquirer loses
21% of the deal value. At the other end of the spectrum, if the premium paid is a mere 10% and the value performance improvement is 40%, the acquirer gains 27% of deal value. Other numbers in the matrix can be appropriately interpreted.
Should the acquirer pay compensation in cash or stock? This is an important financial issue. The answer depends on four factors: overvaluation, taxes, sharing of risks and rewards, and discipline. If the acquired stock is overvalued, then it makes sense for the acquirer to compensate in the form of stock. This happened in the case of AOL's acquisition of Time Warner. Taxes. If compensation is paid in the form of stock, shareholders of the acquired company are not liable to pay taxes. However, if compensation is paid in the form of cash, shareholders of the acquired company are liable to pay taxes. Sharing of risks and rewards. If compensation is paid in the form of stock, the risks and rewards of the acquisition are borne jointly by shareholders of the acquired company and the acquiring company. If the compensation is paid in the form of cash, risks and rewards are borne entirely by the shareholders of the acquiring company. Discipline. If compensation is paid in the form of cash, acquiring company is likely to be more disciplined and circumspect. If compensation is paid in the form of stock, acquiring company can be somewhat negligent.
When the compensation is paid in stock, the commonly used basis for determining the exchange ratio are earnings per share, market price per share, book value per share, and DCF value per share. Earnings per share prima facie reflects earning power. However, it fails to consider differences in growth, risk, and quality of earnings, which can be very substantial. Market price per share is quite relevant in an efficient market where prices reflect earnings growth and risk. However, if the market is illiquid or manipulated, market price per share is not a reliable basis. Book value per share is regarded by many as objective. However, book values are subjective and often deviate significantly from economic values. DCF value per share is ideally suited when fairly credible business plans and projections are available. DCF value per share, however, overlooks options embedded in the businesses. When Tomco was being merged with Hindustan Lever Limited in 1993, three bases were considered for determining the exchange ratio: earnings per share, book value per share, and market price per share. The picture for Tomco and HLL is given in these tables. As far as earnings per share was concerned, Tomco was experiencing a severe decline in earnings per share, and it was expected that Tomco would soon be a loss-making company because its operations had become unviable. Hindustan Lever Limited, on the other hand, was experiencing a steady increase in earnings per share. The drop here is artificial because a bonus was issued in 1991. So EPS was regarded as an unsuitable basis for determining the exchange ratio. As far as book value per share was concerned, Tomco's book value per share was 29.75 and Hindustan Lever Limited's book value per share was 23.80. However, book value per share was not considered as a reasonable basis for determining the exchange ratio for FMCG companies. The most important assets of FMCG companies are intangible assets like brand equity, distribution network, manual talent, and so on, and these are not reflected in accounting. So book value per share was not regarded as an appropriate basis. Finally, the valuers looked at the prevailing market price on June 17, 1993 and decided to determine the exchange ratio primarily on the basis of the prevailing market price. You can see that the exchange ratio was 2 to 15. 2 shares of Hindustan Lever Limited were given in lieu of 15 shares of Tomco, and the exchange ratio reflected largely the prevailing market prices on that date. A market price based exchange ratio is very relevant when the
two companies are actively traded and their stocks are very liquid and the stocks are not manipulated by respective managements. In this case, both these conditions were satisfied, so market price per share was used as the basis for determining the exchange ratio. Of course, shareholders of Tomco objected to it. The courts, however, overruled their objection. A takeover generally involves the acquisition of a certain block of equity capital of a company, which enables the acquirer to exercise control over the affairs of the company. A takeover may be done through the following ways: open market purchase. The acquirer may purchase in the open market the shares of the target company. To negotiated acquisition, the acquirer may purchase shares of the target company by negotiating with the existing promoters or other strategic investors who may have substantial equity stake in the company. Preferential allotment: the target company may allot enough shares to the acquiring company on a preferential basis so that the acquiring company has a significant controlling stake in the target company. Takeovers are subject to an elaborate SEBI takeover code. The key provisions of the code are shown here. Disclosure: when an acquirer acquires 5% equity in a company, the acquirer is required to disclose that information to stock exchange authorities, who have to make that information public. Trigger point: 25%. When an acquirer acquires 25% equity in a company, the acquirer is required to make a public offer for another 26%. The offer price of the public offer is subject to certain guidelines which are meant primarily to protect the interest of small shareholders. After an acquirer has made an offer, competitive bids can be made over a period of 21 days. Potential bidders have to deposit a certain amount in the escrow account. There is a provision for creeping acquisition of 5% in a year by those who already have 15 to 75% equity in a company. If you look at this takeover code, you find that the thrust of the takeover code is on transparency and protection of interest of small shareholders. A takeover can be a friendly takeover or an unfriendly takeover. In a friendly takeover, the target company management is amicably disposed toward the takeover. In an unfriendly takeover, the target company management repels and resists the acquirer. In the US, a number of devices are available for target companies to repel potential acquirers. In India, anti-takeover defenses are relatively fewer. The more important ones are listed here. 1. Make preferential allotments. The target company may make a preferential allotment to friendly investors or promoters in order to enhance their stake in the company. To effect creeping enhancements, under the SEBI takeover code, promoters can increase their stake by 5% every year. So if promoters do not have sufficient equity stake, they can gradually increase their stake over a period of time and become less vulnerable to takeovers. 3. Search for a white knight. A white knight is another organization which has a friendly disposition toward the target company and which tries to rescue the target company from a potential raider. For example, Great Eastern Shipping Company approached Mahindra, who served as a white knight, to repel Dalmias. 4. Amalgamate group companies. Smaller companies are likely to be more vulnerable to a takeover. So if several companies are amalgamated and a larger company is formed, the threat of takeover diminishes. 5. Resort to buyback of shares. The company may resort to buyback of shares in which promoters do not participate. As a result, promoters have a higher stake in the equity of the company after the buyback. 6. Lobby with government and SEBI. Sometimes a target company may lobby with the government and SEBI, as it happened in the case of Bombay Dyeing and Barjoria. We have discussed three modes of acquisition, namely takeover, purchase, and merger. How do they compare? Object. The object of a takeover is to acquire controlling equity stake. The object of a purchase is to buy a unit or division of another company. The object of a merger is to acquire and amalgamate a company in its entirety. Process in a takeover, typically an open market offer is made to acquire controlling block. In a purchase, after the two companies agree on the transaction, various clearances have to be taken. In a merger, after the two companies agree to the transaction, various approvals are required. Taxation of shareholders. In a takeover, when shareholders receive cash compensation, they are liable to pay taxes. Taxation of shareholders is not applicable in a purchase. Taxation of shareholders is not applicable in a merger. Taxation of the companies in a takeover, the companies are not liable to pay any tax whatsoever. In a purchase, the selling company is liable to pay taxes. Taxation of companies is not relevant in the case of a merger. Stamp duty, there may be a nominal stamp duty in a takeover. The stamp duty for purchasing a business unit is likely to be high. There is no stamp duty applicable to a merger. Pricing. Pricing in the case of a takeover is largely market driven. Pricing in purchase is guided by professional valuation. Pricing in merger is also guided by professional valuation. Extent of acquisition. Takeover involves acquiring 51% or more equity. Purchase involves buying 100% of a unit or division along with accompanying liabilities. Merger involves 100% of the company. Consideration. In a takeover, consideration may be in cash or shares. In a purchase, consideration is in cash. In a merger, consideration is in the form of shares typically. To whom? In a takeover, consideration is payable to members. In a purchase, consideration is payable to the selling company. In a merger, consideration is given to members. As we have learned, there are three broad approaches to valuation: asset-based approach, relative valuation approach, and DCF approach. Valuation in acquisitions is often biased because managements of both the bidder firm and the target firm try to justify their position to their respective shareholders. In a friendly acquisition, the management of the bidder firm wants to convince its shareholders that it is buying cheaply, and the management of the target firm wants to convince its shareholders that they are getting good price. In a hostile acquisition, the bidder firm tries to convince shareholders of the target company that they are getting a good price, and the target firm argues otherwise. Acquisition financing was difficult in India till late 1990s. In the last 15 to 20 years, however, bankers and other institutions are willing to give acquisition financing because they have realized that many of these transactions are very worthwhile transactions. The common modus operandi is to set up a special purpose vehicle to acquire the shares of the target company, and loans are taken by this special purpose vehicle. The promoter of the special purpose vehicle may sometimes provide a guarantee for these loans, or in most cases provide a letter of comfort. The quantum of financing is usually 3 to 6 times the EBITDA of the target company. It depends on the nature of the business of the target company and the performance of the target company. Loans usually carry a higher rate of interest. The rate of interest may be 50 basis points to 500 basis points more than what is normally applicable. They are roughly 200 basis points more on average. Track record of mergers. Study after study show that most mergers, some estimates are 60% or more, fail to deliver their intended benefits and destroy economic value in the process. A study done a few years ago analyzed 93 studies covering over 200,000 mergers. It showed that on average, the negative effects of a merger on shareholder value became evident less than a month after a merger is announced and persists thereafter. Here is a very informative graph which shows the cumulative abnormal returns to shareholders of target and bidder firms in public acquisitions. Cumulative abnormal returns take into account market return as well as beta. From this graph, we find that before the announcement date, the cumulative abnormal returns to shareholders of target company and bidder company are more or less similar. But after the announcement date, the two diverge very significantly. The cumulative abnormal returns to shareholders of target company are hugely positive, whereas cumulative abnormal returns to shareholders of bidder company are slightly negative. Cross-border deals seem to be doing worse. Overseas acquisitions have increased significantly from the decade of 1990s due to three reasons. One, quick and easy way to enter overseas markets. Two, scope for exploiting technology, intangible assets and business models is greater. Three, reduction in volatility of cash flows. Lured by these potential benefits, foreign bidders tend to pay more. This is referred to as the cross-border effect. A BCG report of 2007, aptly titled The Brave New World of M&As, argues that larger deals destroy progressively more value. Deals that are above $1 billion destroy nearly twice as much value as those under $1 billion. Here are some conspicuous examples. Vodafone acquired Mannesmann of Germany in 2000 for a deal value of $190 billion. The decline after the third year was $79 billion. AOL acquired Time Warner in 2001 for a deal value of $160 billion. The decline after the third year was $91 billion. Daimler-Benz acquired Chrysler in 1998 for a deal value of $38 billion. The decline after the third year was $33 billion. WorldCom acquired Sprint in 1999 for a deal value of $100 billion, and the decline after the third year was $87 billion. Here are some write-offs of erosions of companies which are more well known in India. In 2009, Hindalco wrote off $1.5 billion for its acquisition of Novelis. In 2010, Vodafone plc wrote off $3.4 billion for India operations. In 2012, ArcelorMittal wrote off $4.3 billion for its acquisition of Arcelor. In 2013, Tata Steel wrote off $1.6 billion for Chorus and others. In 2014, Daiichi Sankyo wrote off over $4 billion for its Ranbaxy's acquisition. The kinds of outcomes that we see for M&A transactions can be explained in terms of standard economic theory or behavioral economics. Standard economic theory argues that these transactions take place in a highly uncertain environment, so there will be winners, there will be losers, and the kinds of outcomes that we see can be explained by the competitive dynamics of that market. Behavioral economics, on the other hand, argues that many of these transactions are misguided transactions or transactions which are affected by behavioral considerations. There are several reasons why value may be destroyed. Informational asymmetry. The seller knows much more about the business than the buyer. The buyer always suffers informational disadvantage. However careful the due diligence may be, the buyer suffers informational disadvantage. I am reminded of a story. A person had a horse. The horse used to limp on some days but walk naturally on other days. He went to a veterinary doctor and said, "Doctor, my horse limps. Please prescribe some treatment for him." The doctor asked him, "Does it limp every day?" The person said, "It limps on some days, it doesn't limp on other days." The doctor said, "Where is the problem? Just sell him the day when it walks naturally." I have a suspicion that when Tatas were looking at Chorus, they suffered from informational asymmetry. Chorus had a lot of hidden problems which came to surface only later. Competitive bidding. In a competitive bidding situation, people tend to overbid. This is known as the winner's curse phenomenon. Unrealistic estimate of synergies, over optimism. This is very common. acquirers in their enthusiasm overestimate synergistic benefits. And in several situations, I found that synergy is often used. Over a period of time, I have developed a mild allergy for the word synergy. Top line obsession. Some organizations are too preoccupied with top line. I presume that Mittal Steel Corporation was driven by a desire to be the numero uno steel player in the world. They wanted to be the largest steel company in the world, and this kind of an obsession perhaps drove them to acquire Arcelor at a high price. Stock price exploitation. If the price of the acquirer is inflated, the acquirer may like to exploit that price. This is what happened in the case of AOL and Time Warner. Lack of discipline during negotiations. This is very common. During negotiations, people tend to lose discipline. Negotiations are notoriously susceptible to rising commitments. Herd behavior. If others are acquiring, you are also inclined to acquire because as human beings you want to emulate others. We suffer from herd mentality. Ego trips. CEOs often have very large egos, and acquisition transactions enable them to exercise ego trips. Poor integration. Often the acquirer does not take into account all the problems that would arise after the acquisition. Post-acquisition integration is always a challenge. The softer aspects of integration are generally overlooked because acquirers are enthusiastic about consummating the transaction. Planning fallacy seems to characterize many acquisition decisions. These decisions are based on delusional optimism rather than rational weighting of gains, losses, and probabilities. Acquirers tend to overestimate benefits and underestimate costs. A commonly observed phenomenon in M&A is winner's curse. Here is a target company T. There are three potential bidders A, B, and C. A bids 100 million, B bids 150 million, C bids 200 million. C emerges as the winner because C has outbid A and B. However, C is often called a cursed winner because C tends to overpay out of ignorance or infatuation or a deadly combination of the two. One company which did very well in acquisitions for nearly 3 decades is Mittal Steel Corporation. From early 1970s, Mittal Steel acquired underperforming companies which were in steel business and which required significant managerial overhaul. They looked at companies which could benefit from Mittal Steel's formidable know-how in steel business and its global footprint. They engaged in protracted due diligence and negotiations to extract a lot of benefits. In fact, some of their acquisitions were made at throwaway prices. That's a tribute to their acquisition strategy. However, Mittal Steel ran into difficulties when it wanted to make a hostile acquisition of Arcelor, a reasonably well-managed company. There, it became a victim of winner's curse phenomenon. What happened in the case of Arcelor? On January 26, 2006, Mittal Steel Corporation made an offer to buy shares of Arcelor at a price of $27.27. Arcelor board rejected the offer. They wanted a higher compensation. They raised all kinds of objections. They said there are vast cultural differences. The transaction would lead to unemployment, so on and so forth. They accused Mittal of having steel of poor quality. They went and said your color is brown and your corporate governance is poor. Perhaps they wanted to instigate him and extract a higher price. They even brought in a rival bidder, a Russian company, and in a competitive bidding situation that emerged, Mittal had to pay $32.2 billion, nearly 86% more than what they had originally envisaged to invest. This is a very interesting case study of how an extremely well run company, which was very successful in its earlier acquisitions, succumbed to the temptation of winner's curse. And Mittal Steel, even now, after 14 years, is worth much less than the price that it had paid to acquire Arcelor.
Tata Steel's acquisition of Chorus is a conspicuous example of winner's curse. In an interview given to Kristen Tan of CNBC, which was telecast on December 1, 2013, Ratan Tata said that when they first looked at Chorus for acquisition, it had a market cap of $5 to $6 billion. Tata Steel made a bid of nearly $7.6 billion, which was accepted by the board of Chorus. Subsequently, CSN of Brazil entered the fray. According to US Takeover Code, competitive bidding is essential when there is more than one bidder. During the competitive bidding, the price went up to $13 billion. Ratan Tata admitted he was stubborn and unwilling to let it go. This is a very common phenomenon. When you're involved in a competitive battle, you want to emerge victorious. As Warren Buffett says, the thrill of the chase blinds the acquirer to the outcome thereof. What are the lessons from chorus? Winner's curse can be a very costly mistake. Herd behavior should be avoided. Tata Steel perhaps was guided by what Mittal Steel Corporation had done in its acquisition of Arcelor a little earlier. Centennial emotion. Tata Steel was celebrating its centenary in 2007, and there was a desire to do something very grand to celebrate a century. And Tata Steel had done extremely well during the preceding 5 to 7 years. So there was all round buoyancy and optimism. Informational asymmetry. Chorus had a lot of hidden problems. Despite the due diligence done by Tata Steel, it could not perhaps detect all the deficiencies in Chorus. Invariably, the seller knows much more about the company than the buyer. Vision driven. Tata Steel was hardly a 5 million ton company, having done very well in the preceding 5 to 7 years. Tata Steel had drawn up a very ambitious vision of becoming a 25 million ton or even a 50 million ton company, and it was almost impossible for them to achieve this grandiose vision in the domestic market through greenfield expansion or brownfield expansion. So they were tempted to go in for the acquisition of Chorus. The lesson here is that one should not be powerfully driven by an ambitious vision. It can dilute rationality. Why do companies make so many wrong acquisition decisions? Perhaps CEOs are guided by sunk costs, having spent a great deal of time, effort, and energy in analysis and negotiations. They convince themselves to pay an extra amount. Overall, the deck seems to be stacked in favor of the CEO and his or her obliging staff. Warren Buffett has offered an interesting solution to this problem. He says, hire two expert acquisition advisors, one arguing for the proposal and the other arguing against the proposal, and their advice should be submitted to the board. Pay the winning advisor 10 times the token sum paid to the losing advisor. Apparently, Buffett has used this solution successfully. Acquisitions are unique investments. There are no dry runs. The entire cost is paid upfront, and the exit is prohibitively expensive. Since the game of acquisitions is often tilted in favor of the seller rather than the buyer, the acquirer must be very circumspect and disciplined. To improve the prospect of creating value, a company must 1. Focus on right targets. It must identify targets with which it has a good strategic fit, cultural fit,
and financial fit. 2. Estimate synergies properly. Thanks to planning fallacy, synergies are often overestimated. They need to be estimated realistically. 3. Negotiate in a disciplined manner. Acquisition negotiations are susceptible to rising commitment, so a great deal of discipline and circumspection is required. 4. Plan and control the integration. Often, post-merger integration issues are glossed over. They are as important as anything else, so they need to be carefully thought through. A good example of a successful merger is ExxonMobil merger. A friendly agreement was reached on 1/12/98 and the transaction was consummated by 1/12/99. The transaction was predicated on three benefits: 1. Cost savings; 2. Complementary assets; 3. Scale for managing risks. A compensation of 26.4% above the market value of Mobil as on November 20, 1998 was paid. The compensation worked out to $74.2 billion. The compensation was paid in the form of stock. The exchange ratio was 1.32. By August 2000, they already reported a synergistic gain of $4.6 billion. It will be instructive to examine the experiences and practices of some companies. We look at Tech Mahindra, Sun Pharma, Godrej Consumer Products, Piramal Enterprises, and IBM. Tech Mahindra has been fairly disciplined and successful in its acquisitions over a period of time, starting with Satyam in January 2009 when it acquired 43% equity stake at rupees 58 per share. Tech Mahindra made a series of acquisitions over a period of time. Most of these acquisitions turned out to be very profitable for Tech Mahindra. Thanks to these acquisitions during the 5-year period 2009-2014, Tech Mahindra grew its revenues and profits at a compound rate of 33% and 24% respectively. These acquisitions augmented service offerings, diminished dependence on telecom vertical, and diversified the geographical base of the company. The company emerged as a formidable alternative to Tier 1 players. Sun Pharma has delivered more value for its shareholders by managing difficult cross-border acquisitions compared to its peers like Dr. Reddy's Laboratories and Wockhardt. Sun's strategy had two planks: one, focus on the US market; two, buy distressed assets inexpensively and turn them around. For example, they turned around loss-making Caraco US and Taro US. Godrej Consumer Products Limited has been very successful in its mergers and acquisitions. Their M&A strategy has three planks: adequate preparation. They assembled a team of talented persons to do M&A, and this team prepared itself adequately for 2 years before doing a deal. Disciplined approach. They developed a playbook so that their M&A is fairly disciplined. Focus. They have followed a 3-into-3 strategy. Their focus has been on three product categories: insecticide, hair color, and personal care, and on three broad geographies: Asia, Africa, and Latin America. The company has been very successful. Nearly 1 dozen acquisitions have been made during the early 2000s. Between 2002 and 2012, sales, earnings, and share price grew by 27%, 33%, and 42% on a compound basis, and the company's market cap rose by 45 times. Piramal Enterprises Limited has been very successful in acquiring and divesting over a period of time. Starting with 1985, they made a series of small ticket acquisitions in the pharmaceutical space and built a formidable business. In 2010, they sold the formulation division to Abbott for 18,500 crores and the diagnostic business to Fortis, generating a lot of value for their shareholders through successful acquisitions and divestitures. IBM has been very successful in its acquisitions. More than 140 deals were done between 2000 and 2012. These acquisitions played a significant role in moving the company toward more profitable technologies and market opportunities in software services. IBM's Business Development Office evaluates acquisition candidates in terms of three criteria: enhancement of capabilities, scalability, leverage of reach. If we look at the way Indian companies manage overseas acquisitions, we find that there is a distinctive India way of managing acquisitions. The features of the India way of managing acquisitions are: one, structure, keep it separate. The acquired company is retained as a separate entity, it is not merged with the parent company. Two, people retain most of the people of the acquired company, don't fire people. Three, process intervenes selectively to enjoy synergistic benefits. Four, speed, go easy and slow. The India way is very different from the way many multinational companies manage their acquisitions. They merge the acquired entity with the parent company, they fire many people, they intervene very substantially in the systems and processes, and they consummate the transaction with great speed. The key lessons of behavioral finance for mergers and acquisitions are: one, better decision making process matters. We don't learn from our mistakes. Two, promote explicit discussion of irreducible uncertainty. Three, rely on the technique of pre-mortem. Four, beware of the advice offered by investment bankers. Five, at some point in the deal, someone should send a memo to CEO as to why the deal should not be done. Six, develop a taxonomy of deals and prepare a checklist for each type of deal. Value creation through acquisitions is always a daunting proposition. Value is created when there are three fits: strategic fit, cultural fit, and financial fit. As you can see from this Venn diagram, there is a very small area in which all the fits are found.
According to McKinsey research, four factors differentiate successful deals from unsuccessful deals in terms of returns to acquirers' shareholders. 1. Strong operators are more successful. 2. Low transaction premiums are better. 3. Being the sole bidder helps. 4. Private deals perform better. According to McKinsey, value creating acquisitions fit into one of the following six archetypes. 1. Improves performance of the target company. 2. Consolidates and removes excess capacity from industry. 3. Creates market access for the target's products. 4. Acquires skills or technologies more quickly or at a lower cost than they could be built in-house. 5. Exploits a business's industry-specific scalability. 6. Picks winners early and helps them develop their businesses. If an acquisition does not fit one or more of these archetypes, it is unlikely to create value.
What is the collective wisdom on mergers and acquisitions? 1. Mergers and acquisitions thrive during periods of stock market buoyancy. There is no satisfactory explanation for this phenomenon under rational finance. However, behavioral finance offers a fairly plausible explanation. During periods of stock market buoyancy, business confidence runs high, so mergers and acquisitions take place with greater frequency. During periods of stock market recession or depression, business confidence runs low, so mergers and acquisitions languish. 2. Acquirers usually pay too much. This benefits primarily the shareholders of the target company but hurts the shareholders of the acquiring company. Typically, in an acquisition, the acquirer may have to pay a premium which may range between 20% to 60%. Sometimes it may be even higher. So on the whole, the primary beneficiaries of these transactions are the shareholders of the target company. and by and large, shareholders of acquiring company may not benefit or even lose a lot. 3. CEOs fall in love with deals and do not walk the way when they should. After having invested sufficient time, effort, and emotion, CEOs would not like to walk away from these deals. 4. Serial acquirers are likely to succeed more than infrequent buyers. This is understandable. Serial acquirers have greater experience, expertise, and discipline in making acquisitions, whereas infrequent buyers lack these advantages. 5. Compared to purchase of public companies, acquisitions of private companies add more value. In the case of purchase of a public company, there is always a reference price and the acquirer has to pay a significant premium above the reference price. The premium may range between 20% to 60% ordinarily and sometimes be even higher. In the case of a private company, there is no reference price, so the acquirer has greater room for negotiating the purchase price. 6. Related acquisitions are likely to generate higher returns than unrelated purchases. This is mainly because very few companies have substantial managerial bandwidth to manage diverse businesses successfully. 7. Integration is hard to pull off. While it may be easy to conclude an M&A transaction, it is very difficult to carry out post-acquisition integration. Business alliances such as joint ventures, strategic alliances, equity partnerships, licensing, franchising alliances, and network alliances have grown significantly. In many situations, well-designed business alliances are viable alternatives to mergers and acquisitions. Here are some conspicuous examples. General Motors and Toyota entered into an unprecedented joint venture agreement in the 1980s. Merck has over 100 R&D alliances with a variety of entities. In 1999, IBM announced business alliances worth $30 billion with companies like Cisco and Dell Computers. Oracle has over 15,000 alliances with its business partners. The common forms of business alliances are joint ventures, strategic alliances, equity partnership, licensing, franchising alliance, and network alliance. Rationale for business alliances: sharing risks and resources, access to new markets, cost reduction, favorable regulatory treatment, prelude to acquisition or exit. Having discussed acquisitions, let us now turn our attention to divestitures or divestments. As we have learned, acquisition means fusion, which is guided by the principle of synergy. This principle says 2 plus 2 is equal to 5, whereas divestitures are guided by the principle of energy, which says 5 minus 3 is equal to 3. So we have two processes, fusion and fission. Now we'll examine fission. Here is an illustrative list of divestment transactions in India. We will discuss demergers, sale of a business unit, and equity carve-outs. A demerger may take the form of a spin-off or a split-up. In a spin-off, an undertaking or division of a company is spun off into an independent company. After the spin-off, the parent company and the spun-off company are separate corporate entities. In a split-up, a company is split up into two or more independent companies. As a sequel, the parent company disappears as a corporate entity, and in its place, two or more separate companies come into being. The rationale for demergers are sharper focus, improvement in incentives, and accountability. Here is an example of demerger. Arvind Limited demerged its branded apparel business to Arvind Fashion Limited and its engineering business to Anvation Heavy Engineering Limited. According to Arvind management, the rationale for demerger is to impart focus, enhance operational efficiency, attract different types of investors as well as management teams, and incentivize management through aligned ESOP schemes. A partial sell-off, also called slump sale, involves a sale of a business unit or plant of one firm to another. It is the mirror image of a purchase of a business unit or plant. The motives for sell-off are raising capital, curtailment of losses, strategic realignment, efficiency gains. On May 21, 2010, Piramal Enterprises sold its formulation division to Abbott Laboratories for 18,500 crore rupees. Subsequently, it sold the diagnostic business to Fortis. Biocon Limited started in 1978 with a focus on specialty enzymes. It did fairly well in that business for many years. In 1998, it entered biopharmaceuticals. Gradually, it realized that its thrust area would be biopharmaceuticals. In 2007, it sold its profit-making enzymes business to Novozymes for $115 million to raise funds to grow pharmaceuticals business, its new thrust area. In an equity carve-out, a parent company sells a portion of its equity in a wholly owned subsidiary. The sale may be to the general investing public or to a strategic investor. Reliance Industries Limited recently did an equity carve-out for its subsidiary Reliance Jio. An equity carve-out differs from a spin-off in the following ways. In a spin-off, the shares of the spin-off company are distributed to the existing shareholders of the parent company, whereas in an equity carve-out, the shares are sold to new investors. An equity carve-out brings cash infusion to the parent company, whereas a spin-off does not. Equity carve-outs are undertaken to bring cash to the parent and to induct a strategic investor in a subsidiary, as it happened in the case of Reliance Industries Limited. Here is a summary view of different types of divestitures. Demerger. In a demerger, shareholders get shares of demerged entities. There may be some value gain on account of sharper focus and better incentives. There is no tax implication. Sale of a business division. The company receives cash compensation which may be deployed in other businesses. Shareholders may get a special dividend. Overall, shareholders may benefit if the cash compensation is deployed judiciously. Equity carve-out. The company receives cash compensation. A strategic investor is brought on board. The benefits to shareholders depend on the value brought by a strategic investor to the table. Historically, business houses in India had some kind of an aversion toward divestments. They viewed divestments as an admission of failure. There was a stigma associated with divestment. All that has changed very significantly in the last 20-25 years. Now business firms regard divestments as a normal part of business life, consider divestment as one of the many responses to a situation, and approach divestments positively. That is why we see so many divestment transactions happening. Here are the summary equations for value creation in acquisitions and divestitures. Acquisition, value created for acquirer is equal to stand-alone value of target plus value of performance enhancement minus the sum of market value of target plus acquisition premium. Divestiture, value created for divestor is equal to price received minus the sum of stand-alone value of divested business plus loss synergies plus disentanglement costs. According to a McKinsey study covering 200 large US companies over a 10-year period, companies with a passive portfolio approach underperformed companies with an active portfolio approach. Best performers systematically divested companies as well as acquired them. A holding company owns the stock of other companies to exercise control over them. Many business groups in India already have a holding company or are moving in that direction. For example, Tata Sons is a holding company of the Tata Group. It has substantial equity stake in a number of operating companies. Bajaj Holdings Investments Limited is the holding company of the Bajaj Group, which has controlling or substantial equity stake in Bajaj Auto and Bajaj Finserv. There are many groups which are moving in that direction. The advantages of a holding company are control with fractional ownership, isolation of risk, enormous financial leverage. Disadvantages of a holding company are partial multiple taxation, parental responsibility, magnified risk. From 1950s onward, many countries all over the world relied heavily on public sector for rapid industrial development. The governments of these countries believed that public sector was an important vehicle for rapid industrialization. However, over the next few decades, it was realized that public sector is highly inefficient and bureaucratic in many ways, and from 1979 onwards, privatization initiatives were undertaken. It started with UK, and privatization initiatives were begun in other countries as well. The rationale for privatization was improvement in efficiency on account of greater autonomy enjoyed by these enterprises, on account of greater accountability to which these enterprises would be subject to, on account of greater employee pride in these enterprises, generation of resources for the government, which often had a significant resource crunch, promotion of popular capitalism. India started its privatization initiative in 91-92. In 91-92, partial privatization of 30 companies was done. This experiment was fairly successful, and Government of India in principle wanted to step up the initiative. I had incidentally the honor and privilege of organizing a program for the officials of Government of India where various aspects of disinvestment were discussed. However, due to political opposition, privatization initiatives slowed down and privatization happened in a very sporadic manner. In 2001, when NDA came to power, there was an fillip given to privatization, and the modus operandi used was strategic sale. In a strategic sale, controlling equity block is transferred to a private group, and strategic sale of CMC, Balco, VSNL, IPCL and HZL was done. By the way, these companies under their new ownership are doing very well. Subsequently, strategic sale was criticized for various reasons, and open market sale was done. Again, this was done somewhat sporadically. Now government wants to step up the initiatives further. How does strategic sale compare with open market sale? Strategic sale has two advantages. One, it brings new technology and expertise to the company. Two, it provides greater incentive to improve governance and management. Against these two advantages, it has one significant disadvantage. It can lead to concentration of wealth. Open market sale has two advantages. One, it can be done in stages as and when political consensus is built. Two, it creates widely held professionally managed companies. However, against these advantages, it has one disadvantage. It does not lead to significant improvement in corporate governance unless the government's stake in the company is brought down to 49% or below that. As long as the government has majority ownership, the organization is likely to be weighed down by the three C's: CAG, CVC and CBI. I've been on the boards of public sector undertakings, and I found that the surveillance and monitoring of these organizations, while it is good to a certain extent, tends to impair operational flexibility and the capability of the organization to cope with the dynamic competition that many public sector undertakings are facing today. Let us sum up our discussion. Mergers, takeovers, divestitures, spin-offs and so on collectively referred to as corporate restructuring, have become a major force in the financial and economic environment all over the world. Corporate restructuring can occur in myriad ways. Business firms resort to a variety of activities that lead to expansion, sell-off, and changes in ownership and control. Mergers represent a very important form of corporate restructuring. Mergers, as used in financial literature, subsume both absorption and consolidation. A takeover generally involves the acquisition of a certain block of equity capital of a company, which enables the acquirer to exercise control over the affairs of the acquired company. While there is considerable controversy about takeovers in the popular literature, scientific evidence seems to suggest that corporate takeovers generate positive gains, that target firms' shareholders benefit, and the bidding firm's shareholders do not lose. Mergers, asset purchases, and takeovers lead to expansion in some way or the other. They are based on the principle of synergy, which says 2 plus 2 is equal to 5. Portfolio restructuring, on the other hand, involves some kind of contraction through a divestiture or a demerger. It is based on the principle of energy, which says 5 minus 3 is equal to 3. A divestiture involves the sale of a division of plant or unit of one firm to another. From the seller's perspective, it is a form of contraction. From the buyer's perspective, it represents expansion. A demerger results in the transfer by a company of one or more of its undertakings to another company. The company whose undertaking is transferred is called the demerged company, and the company or the companies to which the undertaking is transferred is referred to as the resulting company. A demerger may take the form of a spin-off or a split-up. In a spin-off, an undertaking or division of a company is spun off into an independent company. In a split-up, a company is split up into two or more independent companies. A leverage buyout involves concentration of equity in a few hands with the help of debt. The sponsors of a leverage buyout are lured by the prospect of wholly or largely owning a company or a division thereof with the help of substantial leverage. They assume considerable risk in the hope of reaping substantial reward. A holding company owns the stocks of other companies to exercise control over them. The advantages of a holding company are control with fractional ownership, isolation of risk, and enormous leverage. The disadvantages of a holding company are partial multiple taxation and magnified risk. Privatization involves transfer of ownership, generally represented by equity shares, partial or total, of public enterprises from the government to individuals and non-governmental institutions. The privatization programs of various countries have been motivated by a desire to improve efficiency, generate resources, and promote popular capitalism. If you want to learn more about mergers, acquisitions, and restructuring, here is a book that I recommend: Mergers, Acquisitions, and Other Restructuring Activities by Donald D. Pamphilus. Thank you.